Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and an update to our 2021 portfolio with 3 stocks I'm buying in July. It's actually a very timely video because I'll be showing you how to look through your portfolio to find the best stocks to buy that you already own. Because there's a great quote by Peter Lynch that goes, "The best stock to buy is the one you already own." And it's so true. Investors get caught up in always trying to find the next hot stock when it might already be in your portfolio. These are the stocks you've already done the research on. You already know that you like the company, so why not start there? And for these stocks to buy in July, I think the market is giving us a second chance here. We started building a position in energy stocks and financials in November before the rebound, and the portfolio jumped immediately. Last month, we were sitting at a 37% return, beating the market by more than 26% on the year. But lately, those sectors that led the recovery, the financials, materials, and energy, have all sold off. You see it here in the sector tracker at sectorspider.com. Shares of financials have plunged 4.4% over the last month. Industrials, material stocks, all those in those cyclical sectors that we were betting on have underperformed. And you see what it's done to the portfolio, now up just 31% as we head into July, still beating the market but only by 20%. In this video, I'll explain why that part of the market is selling off and why it might be your second chance to get into some of the best stocks of the year. We'll look through the portfolio and I'll show you the 3 stocks I'm buying in July to take advantage of that dip. I'll leave a link to Stock Card in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the Stock Picks section. It's free to follow and you'll get email notifications whenever I buy or sell from the portfolio. And as a special bonus, I've negotiated an exclusive discount for everyone out there in the community. Use the promo code BOWTIENATION, it's all one word and lowercase, for an exclusive discount beyond the free trial. We're getting started, but I've got to send that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, the overall stock market actually hasn't been that bad over the past month, with the S&P 500, the blue bar here, up 2.2%, and the tech-heavy NASDAQ reaching record highs. Even that old school Dow stocks are only down 1%. But then looking back at that sector level, there was that deeper sell-off in financials, materials, and industrials where we had some of our stock picks. And it's been because the market really gave up on 2 key drivers of those sectors, interest rates and inflation. Now, even though we've seen inflation jump by the most in decades, the consumer price index surged 5% last month to a point it's only been once before in the past 30 years. The market just shrugged off inflation numbers and sent interest rates lower. And it's hit some of our biggest winners. Citigroup was as high as $80 a share, but it has dropped 13% since early June. Wells Fargo is down 7% over that same period. Others like Clorox have continued to sell off as pricing pressures for commodities hit those consumer staples companies. But I really think this could be a second opportunity to buy into some great stocks at a discount. With the economy expected to grow around 7% this year, there is no godly reason why interest rates will stay this low. With the Fed pumping trillions of dollars into the system, increasing the money supply by 26% last year, there's no way that we're not going to see higher inflation. Now that's going to boost a lot of these stocks once again, and I think it could happen very soon. So I'm highlighting 3 stocks from the portfolio, 3 stocks to buy in July on this rebound theme, and why I like each one. Our first stock to buy in July is one I think is going to surprise the market the most. $180 billion mega bank, Wells Fargo, ticker WFC. These shares are still up 51% from where we added the stock in late December, but have come down recently on that financial sector sell-off. And to understand why this happened, you just have to look at those interest rates. Wells Fargo reported a cost of deposits of just 0.03% in the first quarter. That's how much it paid on deposits, its funding source for loans. Now, for a while, it looked like interest rates were going to surge higher, helping the bank make more money on those long-term loans, on cars and mortgages, but then rates crumbled and the stock came down. But again, there is no reason to think that interest rates are going to stay this low, and Wells Fargo is one of the best positioned to benefit from those rising loan costs. The auto loan segment has jumped on those higher car prices and could be a big surprise in the second quarter results. Credit card volume has slowed a little bit, but could also pick up during that summer reopening. And another reason why I still like these bank stocks, and all you out there in the nation are going to recognize this, The reason why we bought the shares late last year, all the banks moved massive amounts of money into their cash reserves to cover any potential loan defaults ahead of the pandemic. You see that in the left graph here. Wells Fargo set aside $4 billion in the first quarter and almost $10 billion in the second quarter for those credit losses. But when all that stimulus money got pushed into the system, those credit losses never happened, and the bank is now sitting on over $7 billion in additional reserves compared to what it had in 2019. Cash that it can now put back on the income statement for higher earnings. Wells Fargo specifically is also coming out from under a lot of the restrictions placed on it after its 2016 scandal, especially that asset cap set by the Fed that really prohibited the bank from growing its business. Now, coming out from all this allows the bank to start growing again, and I think that translates into a higher dividend increase later this year. The average analyst target of $47.69 a share is only about 10% higher from here, but I think this one gets back up to $50 a share pretty quickly, especially when that dividend increase is announced and as the company gets out from under that asset cap. We've still got two more stocks to highlight, but this is a great time for a warning here. A very important one anytime you're buying stocks you already own. Nation, I love the idea of dollar cost averaging, whether the stock price is higher or lower from where I bought it, but there is a huge risk here that you need to know about. Dollar cost averaging is just buying more of a stock at different prices. Now, usually people think of this more in terms of when a stock has fallen after they buy it, but it also works the other way too. So if you buy a stock at $100 a share, let's say, and you buy one share, then it falls to $80 each. Now, if you buy another share, you've invested a total of $180, and your average cost is $90 each. So instead of the shares having to get back to $100 for you to start making a return, it only needs to come up that 12% to the $90 each. And again, I do this with my stocks on the way up as well as the way down, just buying more shares every month so I'm building a position over time. But the danger here is something you might not even realize until it's too late. You might keep buying the stock as it falls. You bought at 100, then at 80, maybe you buy some more at 50, 60 and 50, all on the hope that eventually the stock is going to recover and you'll make money. But when a stock crashes and you keep putting more into it, you could end up with 30 or 40% or more of your entire portfolio in this one stock. If that company goes bankrupt or just never recovers, your portfolio is going to be toast. So use dollar cost averaging. Buy more of the stocks you own, the stocks that you know you believe in, but never have more than 5 or 10% of your portfolio in a single stock. We added Madison Square Garden Sports, ticker MSGS, in March ahead of the reopening trade, and it hasn't been as quick to rebound with a 10% loss over the past 3 months. Besides the Marquee Event Center, the company also owns the New York Knicks, a Rangers hockey team, 2 developmental league teams, and an esports franchise. New York has reopened, and we're seeing fans return to those sports that they missed all last year. And while a lot of those consumer retail and reopening stocks have boomed higher, MSGS is still 28% below its pre-pandemic peak. Now, sales are expected at $792 million over the next 4 quarters, nearly triple the last year's sales, and the company should return to profitability this year. We all want to get back to those movies and the arenas, and now with most of the United States open, I think those summer sales surprise to the upside. Households have an estimated $2.4 trillion in savings built up through the pandemic, and they're ready to spend it. And this is a closely held stock with insiders and institutional investors holding 92% of the shares. So it probably won't take much to move those shares higher, especially if retail investors start buying into the stock. I think this could easily go up to $200 each and higher. Probably the biggest disappointment in the portfolio, Clorox, ticker CLX, is down 13% since adding it to the portfolio in January and underperforming the market by 24%. And back in January, you remember, I even said that I was hesitant to add this to the portfolio because it's not the kind of stock that's going to zoom higher, but I think there are a lot of good reasons to own Clorox. This is a safe, stable company that pays a 2.7% dividend yield, twice the average yield of 1.3% on the market, and has produced a 10.9% annualized return over the last 2 decades. That is a solid return on a consistent cash flow stock. And now, while I do think that inflation becomes much more of a problem than investors imagine right now, shares of Clorox have already taken that hit. Shares are down 27% from the peak in August of last year on worries about sales growth and higher input costs, but the company makes these must-buy items and should be able to pass along a lot of those costs to the consumer. Earnings are forecast at $7.13 a share over the next year, but management has beaten these expectations by an average of 14% over the last year. I think you get closer to $7.75 a share in earnings, which puts the price at a 22 times on a PE basis. Clorox here is pretty much the ultimate safety play, a solid value on a quality long-term consumer staple company. The average analyst price target of $190 a share is about 8.5% higher than the current price. Add in that dividend though, and you get to your double-digit return. Click on the video to the right for the 3 small cap stocks I'm buying right now. 3 more of those high-risk, high-return stock ideas. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.